And in your business news, now Chinese markets soared and the renminbi rose today. The advancing, adding about $1 trillion the value of Chinese stocks. The rally was sparked by more speculation. Beijing authorities will begin winding back some of its strict zero-COVID policies. Now, this happened earlier this week, with investors hoping for relief from stringent coronavirus curbs. The Hang Seng Index surging by as much as 8% and posted its biggest weekly gain in 11 years. The Shanghai Composite Shenzhen component also finishing higher, defying a downbeat mood in global markets weighed by the prospects of more U.S. interest rate hikes. And these gains are making global investors wonder whether the worst is over for the world's biggest emerging markets. Now, today's advance also follows news that another big global money manager is cutting its exposure to China. US-based Tiger Global Management is the latest in a string of big names to divest or reduce the exposure to Asia's #1 economy. Now, Tiger has trimmed China's share in its portfolio to mid-single digits last month, down from the mid-teens earlier in the year. The $125 billion money manager joins pension funds in Texas and others like Warren Buffett's Berkshire Hathaway and Masayoshi Son's SoftBank in cutting their stakes or allocations to China. The capital outflows from the mainland markets reached a record high of $176 billion in September. And this chart shows the impact the index of Chinese shares traded in Hong Kong has missed the global stock rally from the pandemic lows. It's lost 34% this year, making it the worst performer among 92 global benchmarks that Bloomberg tracks. This week's rally has fueled hopes that Chinese stocks are finally poised to rebound after $6 trillion in market value was wiped out nearly 2 years ago. Still, the volatility may be too much for some investors, as the Hang Seng China Enterprises Index is having its best week since 2015. That's just mostly erased last week's 9% plunge. Its quick change in direction has also made it the most volatile benchmark in the world. Now, for more analysis on whether Chinese equities are turning a corner, we are joined by Francis Lun. He is CEO of GEO Securities in Hong Kong. Francis, good to have you with us. Now, is the worst over for the world's biggest emerging markets?
Well, I certainly hope so. But judging from what here in the market this week, I think you can make a case that the worst is over. Because the rumor mills is running with the story again and again that China is going to relax its stringent COVID quarantine policies. It was these stringent lockdowns and this endless tests which kill economic growth. Hong Kong recorded the 3.4 decline in economic growth in the third quarter. Chinese figures are just as bad. So I think people are really happy to see there are signs that even the top Chinese government recognize and realize that these stringent lockdowns are destroying economic growth and hurting people. So I think judging from the rebound today, actually this week, I think the government recognizes mistake and will start to slowly relax these lockdown rules. And if that is the truth, that is actually what happened. I think Hong Kong and Chinese market must have bottomed, and then we are turning the corner now.
Yes, as you said, there's lots of positive chatter this week as the plans to end the zero-COVID policy, as well as U.S. regulators ending their audit probe of Chinese companies early. How does that gel with reports then that big foreign fund managers are cutting their exposure to Chinese equities?
You cannot blame the big fund managers for cutting Chinese equities because they've been losing so much money. For the past year, I think if you hold big stocks like Alibaba, Tencent, etc., you are losing 70% of your value. You have to cut loss sooner or later at one time. So I think what is happening is for these big funds, they're just cutting their loss and they try to find opportunities elsewhere. But the problem is this may be the very rock bottom. You are leaving at the lowest point of the market, at the bottom of the market. Maybe these fund managers are making a mistake. So time will tell whether they are right or we are right.
Francis, very good to talk to you as always. Thank you for your analysis. We've run out of time. Francis Lun, CEO of GEO Securities in Hong Kong.